Welcome back to our channel, where we dive deep into important financial topics. Today, we're going to discuss a scenario that has been making headlines recently: what would happen if the United States defaulted on its debt? I'm your host, Carmen. And let's get started. The U.S. Treasury market, with a staggering $24 trillion in debt, is considered the backbone of the global financial system. But have you ever wondered what would occur if the United States couldn't fulfill its financial obligations? Well, that's what we're here to explore. If the U.S. were to default on its debt, it would have far-reaching implications for investors, both large and small. The first major consequence would be a loss of confidence. U.S. Treasury securities have long been viewed as one of the safest investments. But a default would shake that perception. Investors, both domestic and foreign, would lose faith in the U.S. financial system, leading to a massive sell-off of U.S. Treasury securities. But it's not just investors who would be affected. Executives and businesses would also face significant challenges. One of the immediate impacts would be higher borrowing costs. As confidence in U.S. debt diminishes, the government's borrowing costs would rise. This means that businesses would face higher interest rates on loans, making it more expensive to invest, expand, or even meet existing financial obligations. Economists are also closely watching this situation, and they're warning of potential turmoil. A default on U.S. debt would likely trigger substantial volatility in financial markets worldwide. Investors would rush to sell their U.S. Treasury holdings, causing bond prices to plummet and yields to spike. This volatility would not only affect the bond market but also spill over into stocks, currencies, and commodities, leading to increased uncertainty and potentially even a global financial crisis. The consequences wouldn't stop there. The broader economy would be significantly impacted as well. Higher borrowing costs, market turmoil, and reduced confidence would hamper economic growth and potentially push the country into a recession. Businesses would struggle with increased loan costs. Consumers would find it harder to obtain credit, and overall economic activity would slow down. Finally, let's not forget about the global impact. The U.S. Treasury market is a cornerstone of the global financial system, and a default would send shockwaves worldwide. Many countries and financial institutions hold U.S. Treasury securities as part of their reserve holdings. A default would disrupt global financial stability, potentially triggering a domino effect on economies around the world. To mitigate these risks, investors, executives, and economists are already preparing contingency plans. They may diversify their holdings away from U.S. debt, seek alternative safe haven assets, or adjust investment strategies to mitigate potential losses. Additionally, policymakers and government officials would likely take urgent measures to address the default and restore confidence in the U.S. financial system. Well, that wraps up our discussion on the potential consequences of a U.S. debt default. It's a scenario that we hope never happens, as the impact would be significant and far-reaching. But it's important to be aware of these possibilities and understand the potential risks involved. If you found this video informative, make sure to hit the like button and subscribe to our channel for more in-depth discussions on finance and economics. Also, to hedge against inflation, we invest into gold using artificial intelligence. If you're interested in this opportunity, then click the link in this post, because there is a limited time coupon that can save you big money today.